So a big news item hits, and right away you start thinking to yourself, well, this is going to happen and that's going to happen, so I'd better do this. I don't know, tap the brakes on that. Let's talk about it. This is one of the many things we've all done. I've done it more than I will even admit. I know that I know of professionals, very good investors who have done it, and of course, everyone else has done it as well. And that is that we see a big news item, and we begin making assumptions on how this news item is going to affect markets. So A leads to B, leads to C, leads to D. You gotta tread carefully. And I'm going to give you a couple of examples. But first of all, you may not know the whole story. There are ramifications. It's a rippling effect. It's going to ripple for a bit. So think about it, but be careful when you hear a big news item. Many news items can have the opposite effect of what you're assuming. So one example that I've seen many times is, a slowing economy. Well, people who are heavily invested in, let's say, technology like NASDAQ will assume it's going to hurt NASDAQ. But no, on the other hand, you have to remember there are two sides to every trade. On the other hand, if the economy is slowing, that might mean that the Fed would want to lower interest rates, which would excite the NASDAQ. So which way are you going to go? You got to be careful when you're seeing these news items. Or, as we've seen, and I call this capitalism 2.0 now, because the Fed could jump in at any minute and do something, or a series of somethings, and things could turn around right away. So you got to be careful. Here's an example from early 2020. And of course, COVID hits, and man, oh man, that's the most nervous I've been about markets since the meltdown in 2008. And we're all running around with masks on, and we don't know, who's going to lose their jobs, how many jobs are going to be lost, how badly this is going to affect the economy when people aren't working. They're not even going to work. People are afraid to go shop. We had no idea what was going to happen. And so we expected a bear market. We expected, if you had told me that the market was going to drop 60 or 70%, I wouldn't have batted an eye. It wouldn't have shocked me at all. So sure enough, over 30 days, the market went down faster in 30 days than it had ever gone down. And it went down about 34% in 30 days. Armageddon, right? It's all hitting the fan now, right? Well, the assumption was a major bear market, but what happened? The Fed jumped in. We had emergency rate cuts. We had massive quantitative easing. We had backstopping of credit markets from one end to the other. We had direct liquidity pumped into banks. A lot more happened. And then during that time, we kind of got used to it. When the masks didn't feel so funny anymore, and we began to see that the commerce was still taking place, particularly online, right? People were still shopping online. So what happened? It just turned around, didn't it? We had a V-shaped recovery. And if you were out of the market and you kept waiting for the right side of that V to fall apart, it didn't. And that's because we made assumptions about what was going to happen over the next several months. It didn't happen. Here's another example. In early 2025, President Trump comes out with these tariffs. And they were so big, and they were so broad, and they kept changing. What did you think was going to happen? A lot of people thought we were going to have another bear market. Well, sure enough, we did. And, the market dropped, whatever that was, I believe around 20%. And who knows how bad this is going to get? Well, sure enough, what happened? Another V-shaped recovery. And, how many people thought that was a head fake right there? And now, we had this great recovery again. And an investor couldn't have been blamed for wondering if COVID was going to just cause great harm to us. And with the tariffs, again, it was uncharted territory. We didn't know what to do. I couldn't blame an investor for being nervous. But if you made the wrong assumption, you lost. You lost when the market was coming back up on the right side of the V. So the moral here is making assumptions on where the market goes based on a news item can be dangerous. So we have to stay on top of the news, obviously, but if you're an active investor, always have the proper risk management in place, things like position size and your maximums, your loss maximums. And unless you're long-term, never make long-term assumptions. And I mean long-term. There are probably a majority of investors, particularly people in 401ks, they're not going to be jumping around like an active investor is when the markets go bad. They're just going to say, I'm going to ride this sucker out, and sooner or later, it's going to be okay. And guess what? Those people, they did okay, didn't they? Meanwhile, those who are jumping around because they had that crystal ball and they figured they knew exactly where markets are going to go, what happened? They got hosed on the right side of that V. So be very careful. Thanks. See you next time.